If you want to invest your money but feel completely lost about where to even start, you need to understand this one fundamental concept first. It's called a portfolio. Without understanding what a portfolio is and how it works, your money will have no clear direction or purpose. Stay with me for the next 9 minutes, and by the end of this video, you'll know exactly what a portfolio is, why every beginner investor needs one, how portfolios actually protect your money, and most importantly, the simple 5-step process to build your very first portfolio today, even if you only have $100 to invest. So let's start with the absolute basics. What exactly is an investment portfolio? Think of it like this simple analogy that makes everything crystal clear. Imagine you're going to the grocery store to buy fruit. You don't just buy one type of fruit, say only apples. Instead, smart shoppers get apples, oranges, and bananas. Why? Because if apples suddenly go bad or cost too much next week, you still have oranges and bananas to eat. Your fruit collection protects you. Your investment portfolio works exactly the same way. It's simply a collection or basket of different types of investments that you own. These could be stocks, bonds, ETFs, cash, real estate, cryptocurrencies, whatever you decide to put your hard-earned money into over time. Here's the crucial point beginners miss. The portfolio is your total picture of all your investments working together. It's not just one stock, it's not just one investment or one account. It's everything you own combined into one complete financial picture. Let me show you a concrete real-world example. Say you have $1,000 to invest for the first time. You have two choices. Choice 1, put all $1,000 into a single company stock like Apple. If Apple goes up 30%, great, but if Apple drops 30%, you lose $300. Choice 2, smart choice, split your money strategically. $400 into an S&P 500 ETF that holds 500 different companies, $300 into 3 different individual stocks you like, and $300 into bonds for safety. That entire collection, that's your portfolio. Here's the single most important key to understand. The portfolio isn't just the individual investment pieces sitting next to each other. The portfolio is how all those pieces work together as a complete system. Smart, successful investors don't spend all their time hunting for the perfect individual investment. They spend their energy building portfolios that grow steadily and predictably over time, regardless of what happens in individual companies or even the overall stock market. That's the portfolio power you need to understand. Now that you understand what a portfolio is, let me break down the 3 most common types of assets that beginners actually put into their portfolios. Understanding these 3 building blocks is genuinely step 1 to investing success. Number 1, stocks. Stocks represent actual ownership pieces in individual companies. When you buy one share of Apple stock, you literally own a tiny fraction of the entire Apple company. Company. If Apple creates new products, grows revenue, beats earnings expectations, your stock value grows right along with the company. Apple stock has returned over 1,000% in the past 10 years. Incredible potential. But here's the reality check. Individual stocks can also drop 30 to 50% in months during market corrections. Tesla dropped 65% in 2022. High reward potential? Definitely a high risk. Number 2, bonds. Bonds work completely differently. When you buy a bond, you're essentially lending money to either a government or corporation. They promise to pay you regular interest called coupon payments over time, then return your original investment amount when the bond matures. U.S. Treasury bonds are considered the safest investment in the world. A 10-year Treasury might pay 4% annual interest, much safer than stocks, but your money grows much slower. Perfect for the safety portion of your portfolio. Low risk, low but steady reward. Number 3, ETFs and index funds. ETFs, exchange-traded funds, provide instant diversification in one simple purchase. The SPY ETF owns all 500 companies in the S&P 500 index. Apple, Microsoft, Amazon, Google, all America's biggest companies. When you buy one share of SPY for about $500, you instantly own tiny pieces of all 500 companies. VTI holds the total U.S. stock market, over 3,500 companies. ETFs give you broad market exposure instantly without picking individual winners. Real beginner portfolio example: imagine you're 25 years old, just starting your investing journey with $5,000. Here's what a simple, smart portfolio looks like: 60% ETFs, $3,000, VTI, total market, plus VOO, S&P 500, 30% individual stocks, $1,500, AAPL, MSRT, maybe KO or JPM, 10% bonds or cash, $500, treasury bonds or high-yield savings. Notice something crucial: these three asset types balance each other perfectly. When stocks drop during recessions, bonds often rise or stay stable. When the economy booms, stocks lead the way while bonds lag. ETFs smooth out individual stock volatility. Three simple building blocks working together systematically. This portfolio approach isn't complicated rocket science, it's just smart risk management. Now you might be wondering, why should I care about portfolios when I could just buy a few hot stocks and hope for the best? Here are the three compelling reasons portfolios matter far more than any single investment. Reason 1: risk management through diversification. Picture this scenario. You invest all $10,000 in one exciting stock, say a hot tech company. If it goes up 50%, amazing, you're instantly rich. But if that company hits trouble, bad earnings, scandal, recession, and drops 50%, you've lost $5,000. Irrecoverable damage. Now imagine spreading that same $10,000 across 10 different investments. When one drops 50%, your total portfolio might only drop 8 to 12%. The other 9 investments balance the loss. Portfolios genuinely protect your money. Reason 2: better long-term returns than stock picking. Professional stock pickers, mutual fund managers with decades of experience, underperform simple market index funds 90% of the time over 15+ years. The S&P 500 index has delivered approximately 10% average annual returns for the past 100 years, including crashes, recessions, and wars. Simple ETF portfolios tracking these indexes beat most professional stock pickers over meaningful time periods. Reason 3: psychological peace of mind. Market crashes happen. The S&P 500 dropped 34% in 2020, 24% in 2022. Single stocks can drop 70 to 90%. A diversified portfolio typically drops 15 to 25% maximum during these periods. You panic less, sell less at bottoms, and actually buy more when others panic. Portfolios let you sleep at night. This simple truth explains Warren Buffett's famous advice to most investors: don't waste time picking individual stocks. Buy a low-cost S&P 500 index fund like VOO or SPY and hold it for decades. Portfolios succeed by being boring and systematic. Ready to build your actual first portfolio? Follow this dead simple 5-step roadmap. Step 1: open brokerage account, 5 minutes. Choose Vanguard, Fidelity, Charles Schwab, or Robinhood. All offer free ETF trading, $0 minimums for most investments. Link your bank account. Step 2: fund with starting capital, $100, $500, $1,000, whatever you can afford. Start small, add monthly. Step 3: buy core ETFs, 70% allocation. VTI, total U.S. stock market, plus VOO, S&P 500. These two ETFs give instant diversification across thousands of companies. Step 4: add individual stocks, 20% max. Pick 3 to 5 companies you actually use: AAPL, MSFT, COST, your bank. Limit each to 5% maximum of total portfolio. Step 5: safety allocation and rebalance yearly, 10%. VTIP, inflation-protected bonds or high-yield savings. Once yearly, sell winners and buy laggards to maintain target percentages. $700 ETFs, $200 stocks, $100 bonds. Total time? 30 minutes. Your first portfolio is live and growing. Congratulations! Now you understand portfolios completely. Your simple path to investing success starts today. Next video breaks down ETFs in detail. They're genuinely the easiest way for beginners to build instant diversification. Hit subscribe so you don't miss it. Pause this video right now. Open your brokerage account and take step 1 today. Start with $100 if that's all you have. You've got this. See you in the next one.